and welcome back. Based on a new report from the Labor Department on Thursday, the number of Americans filing new claims for unemployment benefits jumped to the highest levels since October of 2021, pointing to bigger cracks in the labor market. With inflation also falling below 5% for the first time in 2 years, this could allow the Federal Reserve to pause rate hikes next month and potentially start reducing rates later this year if inflation slows down further and the labor market sees additional softening as well. So in today's video, I'm going to unpack this latest report from the Labor Department, as well as some challenges that Americans are facing right now. Also, stay tuned because at the end of this video, I'm going to provide a summary as well as some advice for you guys because I see a bumpy road ahead here. So here's the actual report from the Labor Department that was posted on the 11th of May here, and this is their initial jobless claims. I want to provide a definition for you guys before I dive into this report here. It says here, an initial claim is a claim filed by an unemployed individual after a separation from their employer. The count of U.S. initial claims for unemployment insurance is a leading economic indicator here. So here's the actual report that was just released from the Labor Department, which was released today at the time of this video, which is 11th again. So this is for the week ended May 6th based on seasonally adjusted initial claims. So initial claims seasonally adjusted came in at 264,000, an increase of 22,000 from the previous week's level of 242,000. By the way, the street was forecasting that initial claims was going to be 245,000. So therefore, it came in above expectations at 264,000. And this, by the way, is the highest level of initial claims since October 30th of 2021. Also, the 4-week moving average was 245,250. That's the highest level for this average since November 20th of 2021. So not only were the initial claims higher than expected, but also they jumped to the highest levels since 2021. Also, as a note right here, this could mark the start of an upward trend due to the lagging effects of the Fed rate hikes, which began in March of last year. In other words, rate hikes don't have an immediate impact on our economy. Now, here's something I found to be very interesting as well, because when looking at initial claims, seasonally adjusted, compare this to 1 year ago. So from 1 year ago compared to May 6th. So compared to 1 year ago, it's a 20% increase in initial claims for unemployment benefits. Also, the 4-week moving average, based on my dumb math, going from 213,000 from 12 months ago, now it has increased to 245,000. That's a gain of 15% year over year. Also, another report was released today as well. This is the PPI, or the Producer Price Index, which is a measure of prices for final demand of goods and services that increased by 0.2% against the estimate of a gain of 0.3%. So it came in slightly below expectations here. Also, the headline PPI rose just 2.3%, down from the 2.7% we saw in March. It's also the lowest reading since January of 2021. Also, as a note right here, this is yet another sign that inflation is actually winding down, pushing bond prices higher and, of course, causing the yields to decrease. As you can see right here, this is the yield on the 10-year U.S. Treasury note, which is tied fairly directly to average mortgage rates. So when the yield decreases, so in general do mortgage rates as well. So at the time of filming this video, which is around noon on the 11th, the yield on the 10-year is at 3.388%, a decrease of approximately 5 basis points compared to yesterday. So the effects regarding mortgage rates today for that is that mortgage rates decreased 8 basis points today, down to 6.49%. Having said that, though, rates are still above last year's level at 5.41%. In other words, a gain of 1.08 percentage points over the last 12 months. That, by the way, is according to the Mortgage News Daily for people with exceptional credit, of course, average rates at 6.49%. But look at this, because according to Investopedia.com, as of today, the average 30-year fix is at 6.91%. So what's happening right now, given that the most recent reports are showing that inflation is actually cooling down, is that investors are now predicting the Fed is actually going to pivot later this year, even though the Fed is saying they're not going to pivot. But investors are basically forecasting for that. So here's something I found to be really interesting as well. This is the Fed Rate Monitor tool, which is on investing.com. This is showing expectations of future rate hikes and also future rate decreases by the Fed this year. So the next meeting is on June 14th this year. So right now, the upper range for the federal funds rate is at 5.25%. So the street is forecasting by a 90.6% probability that the Fed is actually going to pause rate hikes in their next meeting. So in other words, they're not going to increase or decrease rates in the next meeting on June 14th. At least that's what the street is forecasting right now. In their next meeting on July 26th, the street is split whether or not the Fed's going to pivot or keep rates at 5.25%. So there's a 47% probability that the Fed's going to decrease rates to 5%. That'd be a 25 basis point rate decrease. And also a 48% probability they're going to keep rates at 5.25%. Now here's where it gets really interesting though, because in their meeting in September, they're calling for the Fed to pivot to decrease rates to 5% by a 48% probability. Then in their next meeting in November, they're also calling for rates to decrease once again by 25 basis points, at least by 45% probability. Then by December, another rate decrease down to 4.50%. Therefore, overall this year, the expectation is for 3 consecutive 25 basis point rate decreases in the last 3 meetings by the Fed this year. Again, having said that, Jerome Powell, who's the chair of the Federal Reserve, has given no indication they're going to pivot anytime soon, even though investors are predicting for 3 consecutive 25 basis point rate hikes later this year. Before I share a summary of today's video, as well as some advice for you guys as well, I want to share some things that are concerning me regarding our economy, which of course could impact our US housing market. So for example, last Friday, hourly earnings saw an increase of 4.4% year over year. This is an increase of hourly earnings in the US from April last year to April this year, a 4.4% increase. However, though, when accounting for the inflation numbers at 4.9%, this increase of wages, a gain of 4.4%, is actually negative. So when looking at inflation, again at 4.9%, wage growth will actually be negative by 0.5% year over year. Additionally, when looking at price increases compared to 1 year ago for basic necessities like electricity and food, it's actually a gain of around 7 to 8%. So for example, based on the most recent CPI report for April, electricity increased by 8.4%. Also, food increased by 7.7%. So when we count for inflation, wage growth is negative, yet inflation for basic necessities like electricity and food is up by about 8% year over year. Here's something else that's concerning to me as well. Regarding revolving debt for the first quarter this year, that increased by 12.3% compared to the first quarter of 2022. By the way, revolving debt would be credit cards or home equity line of credits, for example. And in general, these are debts that have a variable rate. So therefore, when the Fed increases the federal funds rate, in general, the interest rate you pay for these loans or these balances here actually increases as well. So for example, here's a really good table from the Federal Reserve. So the average credit card interest rate for Q1 this year was 20.09%. This is much higher compared to pre-COVID levels because back in 2018, it was 14.2%, 2019, just over 15%. And in 2020, it was 14.71%. Also, according to creditcards.com, the average interest rate for a credit card is 20.63%. Now, here's something to keep in mind. Actually, two things. Number one, this is an all-time record high, average interest rate of 20.6% for new credit cards. That's number one. Number two, this was the average rate before the Fed increased the federal funds rate just a few days ago. So the current rate or the current averages is likely to be closer to 21% and not 20.63%. I also want to share how this could be impacting people right now. Let's say you have a credit card balance of $10,000 and your interest rate is a whopping 20.6%. This means every single month you're paying approximately $172 per month in interest only to pay off the interest each month on that credit card. And keep in mind that $172 per month payment for interest does not include any principal pay down. So that's only your interest paid for a $10,000 balance for a credit card. Also, according to creditcards.com, a whopping 76% of the 100 cards they track are now advertising a maximum interest rate of 27% or more, while 43% saw a cap above 29%. Also, a record number of credit cards, including some reward cards, are even assigning APRs over 30%, which until recently was unheard of. Here's something else that's concerning as well, because delinquencies for auto loans, credit cards, mortgages, as well as personal loans have all increased compared to 1 year ago. This is according to VantageScore.com for March. So for example, auto loans for 30 to 59 days past due, DPD means days past due, that increased from 1.35% to 1.65%. Credit cards, mortgages, as well as personal loans also increase as well. Something I found to be remarkable as well is that for each of these buckets here, 30 to 59 days past due, 60 to 89 days past due, as well as 90 to 119 days past due, every single bucket here saw an increase compared to 1 year ago. So in other words, delinquencies increasing for each of these products here. So I want to provide a summary of today's video because of course that was a lot of information. If you guys are still watching this video, I appreciate you, and please hit the like button if you could. So here's some summary as well as some advice for you guys as well. So number one, initial jobless claims in the US last week jumped to the highest levels since October of 2021. Also, the producer price index, or their PPI, grew at a slower pace than expectations. With the labor market slowing, the PPI up less than was previously forecasted, inflation dipping below 5% based on the most recent CPI report, the street is forecasting that the Fed will pivot later this year, potentially lowering rates by September this year. So the forecast here is calling for 3 consecutive 25 basis point rate decreases later this year. Of course, no guarantees regarding that because the Fed has not signaled they will decrease rates anytime soon. Instead, they're taking a wait and see approach to see how inflation winds down in the months ahead. It's worth noting here that current advertised rates here are already factoring in a pause by the Fed and a potential decrease by the Fed later this year. Also, as I noted here, there's some concerning trends in our economy as well. So inflation for basic necessities in life, such as electricity and food, are still high, increasing by about 8% year over year. Meanwhile, wage gains are negative due to a 4.4% increase in wage growth this April compared to an inflation rate of 4.9%. Therefore, wages are down by 0.5% when you adjust for inflation. Also, new credit card interest rates are an all-time record high of approximately 21%, which is absolutely insane. On top of that, the total dollar amount of revolving debt is still very high as well for HELOCs and credit cards, for example. And of course, in general, HELOCs and credit cards have a variable rate. So when the Fed increases rates, so can rates for credit cards and HELOCs as well. And of course, that increases your monthly payments on that debt, making it harder to pay off those balances, especially if you have a financial hardship. Also, as I noted, delinquencies for auto loans, credit cards, mortgages, and personal loans have increased compared to 1 year ago as well. So here's some advice for you guys, because we'll likely have a bumpy road ahead regarding our economy in the US right now. So if you're an employee, let's just say you're a W-2 employee, you have an employer, add as much value as possible to your employer right now. Ask how you can help and take on more responsibility. There's a lot of talk about quiet quitting right now, which is another word to say slacking off. Now is not the time to slack off on your job, because those are the people that are first to go during layoffs, for example. If you're not happy with your job, I understand. I was a CPA, also worked as a personal banker for a major bank as well, in which in general, those jobs I didn't enjoy overall. In the short term, I did enjoy them, but overall, I find YouTube and of course being a real estate agent is far more enjoyable and also rewarding in many areas in my job here. So if you're not happy with your job, find something you enjoy, learn a new skill. Life is too short to be working a job you do not enjoy. Now, don't get me wrong here. I'm not saying to quit your job. I'm saying that now may be a good time to learn a new skill to get you on a path to a job you actually enjoy in the future. And lastly, this may be easier said than done, but I would strive to save as much money as possible this year, and of course, pay off high interest debt, such as credit cards and HELOCs, for example. So if you were to pay off your credit card balance that has a 20% interest rate, you just gave yourself a 20% return on your investment, which obviously is much higher than the long-term averages for the stock market, for example. And with that said, please comment below with your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I really appreciate that. Of course, I appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.